Trading in the zone, mastering your inner game for market success. The world of financial trading is often perceived as a battleground of strategies, indicators, and news feeds. While these external factors play a crucial role in identifying potential opportunities, lasting success in the market hinges on a far more personal and often overlooked element, the trader's mind. Mark Douglas's seminal work, Trading in the Zone, delves deep into this psychological landscape, arguing that mastering one's mental state is the ultimate key to consistent profitability. At its core, Trading in the Zone emphasizes that trading is a probability game, and our inherent human tendencies often sabotage our ability to think and act in a way that aligns with these probabilities. Fear, greed, hope, and regret, emotions that are natural to the human experience, can become significant obstacles when making trading decisions. Douglas argues that to trade in the zone is to cultivate a state of mind characterized by unwavering discipline, objectivity, and a deep acceptance of risk. One of the fundamental concepts Douglas introduces is the idea that randomness and uncertainty are inherent in the market. No matter how thorough our analysis, the outcome of any single trade is never guaranteed. This understanding is crucial because it allows traders to detach themselves from the outcome of individual trades and instead focus on the long-term probabilities of their strategies. When we accept that losses are an inevitable part of the game, we are less likely to be swayed by fear after a losing trade or become overly confident after a winning one. Consider a trader, Sarah, who has developed a well-tested trading strategy with a 60% win rate and an average winning trade that is twice the size of her average losing trade. Statistically, Sarah has a profitable edge. However, if Sarah has not mastered her psychological game, her results might deviate significantly from these probabilities. Example 1. The grip of fear. Sarah enters a trade based on her strategy's signals. Initially, the trade moves in her favor, showing a small profit. However, memories of past losses start to creep into her mind. Fear of the trade reversing and turning into a loss overwhelms her. Despite her strategy dictating a specific profit target and stop-loss level, Sarah prematurely closes the winning trade, securing a small gain but missing out on the potential for a much larger profit. Later that day, she enters another trade. This time, the trade immediately moves against her. Fear of a significant loss paralyzes her. She hesitates to exit the trade at her predetermined stop-loss level, hoping that the market will turn around. The loss continues to mount, far exceeding the risk she had initially planned for. In both scenarios, Sarah's fear-driven actions prevented her from adhering to her profitable strategy. Her inability to accept the inherent risk and uncertainty of each trade led her to make emotional decisions that undermine her potential for long-term success. Trading in the zone would require Sarah to recognize these fear-based patterns, understand their origin, and consciously choose to act in accordance with her predefined trading plan, regardless of the immediate emotional discomfort. Example 2. The allure of greed. Another common psychological trap is greed. When a trade moves favorably, the desire for more profit can become overpowering, leading traders to deviate from their strategies. Let's revisit Sarah. This time, she enters a trade that quickly becomes highly profitable. Her initial profit target is reached, but instead of taking profits as planned, greed takes over. She believes the price will continue to rise indefinitely and decides to hold onto the position, hoping for even greater gains. Suddenly, the market reverses sharply. Sarah, now clinging to the unrealized profits, hesitates to exit. She tells herself that it's just a temporary pullback and the price will soon resume its upward trajectory. However, the reversal continues, and the significant profit she once had evaporates, eventually turning into a loss. Trading in the zone requires the discipline to stick to one's trading plan, including predetermined profit targets. Greed distorts our perception of risk and reward, leading us to make irrational decisions based on the fantasy of unlimited profits rather than the reality of market fluctuations. A trader in the zone understands that taking consistent, planned profits is essential for long-term success, even if it means missing out on the occasional home run trade. Example 3. The illusion of hope. Hope can be a powerful force in life, but in trading, it can be a detrimental emotion when it prevents us from acknowledging reality and taking necessary action. Consider John, who enters a long position in a stock based on a specific bullish signal. Initially, the stock price moves in his favor. However, negative news emerges regarding the company, and the stock price starts to decline. John's trading plan dictates that he should exit the trade if the price falls below a certain level. Despite the clear signal to exit, John clings to hope. He tells himself that the negative news is just temporary noise and that the stock will eventually recover. He ignores the mounting evidence against his position and refuses to cut his losses. As the price continues to fall, John's initial small loss turns into a substantial one. Trading in the zone demands that we trade based on probabilities and objective analysis, not on wishful thinking. Hope can blind us to the reality of a losing trade and prevent us from taking timely action to protect our capital. A trader in the zone understands that admitting a mistake and exiting a losing trade is not a sign of failure, but rather a prudent risk management strategy. Example 4, the burden of regret. Regret is another emotion that can significantly impact a trader's decision-making. Missing out on a profitable opportunity or making a losing trade can lead to feelings of regret, which can then influence future trading decisions in a negative way. Imagine Mary, who decides not to enter a trade based on her strategy because she is feeling hesitant. The trade subsequently turns out to be highly profitable. Mary is filled with regret for missing out on the opportunity. The next time a similar setup appears, Mary is determined not to miss out again. However, her regret from the previous missed opportunity leads her to enter the trade prematurely without all the necessary confirmations from her strategy. This impulsive entry results in a losing trade. Trading in the zone involves learning from past mistakes without allowing regret to cloud our judgment. Every trader will miss out on opportunities and experience losses. The key is to accept these as part of the game and focus on executing our strategy consistently. Regret can lead to impulsive and irrational decisions driven by the desire to recoup missed profits or losses rather than by objective analysis. Cultivating a zone-like state. Trading in the zone is not about eliminating emotions entirely, as that is impossible. Instead, it's about understanding how these emotions can affect our trading and developing strategies to manage them effectively. Douglas outlines several key principles for cultivating a zone-like state of mind. Understand and accept risk. Truly accepting that losses are an inevitable part of trading is the foundation of trading in the zone. When we accept risk, we are less likely to be fearful of losing trades and more willing to take necessary actions, such as cutting losses promptly. Define your edge. Having a well-defined and tested trading strategy that gives you a statistical edge in the market is crucial for building confidence and reducing uncertainty. Understanding the probabilities of your strategy allows you to focus on the long-term outcomes rather than the results of individual trades. Predefine risk and reward. Before entering any trade, clearly define your entry point, stop-loss level, and profit target. This pre-planning helps to remove emotional decision-making during the trade. Stick to your plan. Discipline is paramount in trading. Once you have a trading plan, adhere to it rigorously, regardless of your emotional state or short-term market fluctuations. Focus on the process, not the outcome. Shift your focus from the outcome of individual trades to the process of executing your trading plan consistently. By focusing on doing the right things, the positive outcomes will follow over time. Manage your expectations. Avoid unrealistic expectations of instant riches. Trading is a marathon, not a sprint. Focus on consistent, incremental gains over the long term. Believe in your consistency. Develop unwavering faith in your ability to execute your trading plan consistently, even in the face of losses. This belief comes from preparation, practice, and a deep understanding of your edge. Trading in the zone is a continuous journey of self-awareness and psychological mastery. It requires ongoing effort to identify and manage our emotional biases and to cultivate the mental discipline necessary for consistent success in the unpredictable world of financial markets. By embracing the principles outlined in Trading in the Zone, traders can move beyond the emotional roller coaster of trading and develop the mindset of a consistently profitable professional. The edge is not just in the strategy, it's profoundly within the trader.